Welcome to the Deep Dive. Today, we're taking a fascinating journey inside the world of long-term investing. We'll be looking specifically through the lens of a detailed annual letter to our partners from Giverny Capital, dating back to 2012. Think of this as a behind-the-scenes look, really, at how a value-oriented fund manager viewed the market, their holdings, and, their own performance during a pretty critical period.
That's right. And our mission here in this deep dive is to pull out the most important sort of nuggets of knowledge from this specific document. We'll try to uncover how Giverny Capital navigated what was, a complex financial landscape back then. We'll learn about their unique investment philosophy and even explore their very candid reflections on past mistakes. For you, the learner, this offers a really rare insight into the mindset and the mechanics of disciplined, long-term wealth creation.
Okay, let's jump straight into the numbers then, because Giverny Capital had, an impressive year in 2012. Their portfolio saw a 21.5% return. That significantly outperformed their benchmark's 12.5%, and that's even after accounting for a 2% loss because of Canadian currency fluctuations. So a 9.0% outperformance just for that year.
Yeah, but the real story, I think, emerges when you look beyond just 1 year. It always does, right? Since they started, back on July 1st, 1993, their compounded annual growth rate has been 14.0%. Compare that to their weighted benchmark 7.0%. That's an annualized outperformance of 7.0% every single year on average.
Wow.
And even if you strip out the effect of the appreciating Canadian dollar since '93, their portfolio still returned 15.4% annually versus 8.3% for the benchmark.
Yeah.
That kind of consistency over nearly 2 decades, it's truly remarkable.
That really is.
It just underscores that disciplined, long-term value investing can work. It can consistently beat the market, not just in the good years.
Right, across different cycles. And their long-term objective is pretty ambitious, too. Maintain an annual return that's 5% higher than their benchmark. It's also kind of interesting. They have this unique tradition. Since 2004, their letters cover features an artwork from their corporate collection. In 2012, it was Lynn Cohen's untitled Smiling Couch. Maybe a little nod to finding value where others don't look.
Could be, yeah, a subtle touch.
So digging deeper into their specific portfolios, we see the Giverny U.S. portfolio, all in U.S. dollars, returned 22.8% in 2012. That was against the S&P 500's 16.0%, and it marked their 5th straight year of beating the S&P. But what about Canada? Was it the same story there, given the different economic picture you mentioned?
Well, not quite the same picture, but still very impressive results. The Giverny Canada portfolio, which has been 100% Canadian equities since 2007, and also had a stellar 2012, it returned 24.2%.
Okay.
And that was versus the S&P TSX, Canada's main index, which only returned 7.2%. Big difference.
Huge difference.
Yeah, and they point out that this Canadian portfolio is very concentrated. It has little correlation to the TSX index, which means its relative performance, good or bad, is often going to be pretty high. It's a focused bet.
And that concentration certainly paid off in 2012. Their main Canadian holdings did exceptionally well. The All-Star, as they called it, was MTY Foods. It rose 45%.
45%, yeah.
Dollarama also saw a big gain, 33%. And Valiant Pharmaceuticals was up 28%. These aren't exactly, flashy tech stocks, are they? What does that tell us?
Exactly. It tells us they're not chasing headlines. These are things like consumer staples, specialty pharma. It reflects their disciplined value approach. Find strong businesses, maybe not glamorous, but ones that generate consistent returns. Solid, understandable companies.
Makes sense. So beyond just the portfolio numbers, Giverny Capital offers this really compelling macroeconomic review of 2012. It seemed like a tough year globally, yet they called it the year of the stock picker. How did they square that? What was their view?
They did, and it's crucial to look beyond just the numbers here. This macro view highlights the contrasting environments they were working in. So despite slowing Western and Eastern economies, their specific portfolio companies kept growing profits and intrinsic values.
Okay.
For instance, in the U.S., the housing market finally started to rebound after 6 long years. And despite, deep skepticism everywhere, the S&P 500 posted a 16% total return. As they put it, that old saying about the market climbing a wall of fear, never seemed more true.
Right. Fear creates opportunity.
Exactly.
But Canada was different, you said.
Yeah, Canada was quite different. Natural resources companies had a really difficult year. And the Canadian real estate market was showing signs of, running out of steam. The S&P TSX index only climbed 7% in 2012. much weaker.
And what about globally? They mentioned China.
They did. They highlighted China's increasing role, obviously, but noted stock market investors there weren't really getting rewarded. The Shanghai Stock Exchange was flat in 2012 and still way down, like 63% from its October 2007 high. And this was despite all the announcements of excellent GDP growth.
Interesting disconnect. And Europe?
Europe was, well, mired in problems. Giverny observed these seemed more cultural rather than economic, and the common currency just complicated things further. Yet even with all those challenges, they admired several quality European companies. This reinforces their belief that, quote, quality has no nationality. A key insight, really.
Yeah, that is key. Great businesses can be found anywhere, regardless of the headlines, if you know what to look for. The letter also points out something interesting, how the media often focuses on bad news, while really significant good news can go largely unnoticed. One example they gave, with potentially huge consequences for decades, is what Giverny calls the American energy revolution. Sounds almost too good to be true, right?
It really does, and that's what makes their perspective so fascinating. Think back, just 5 years before 2012. Oil was at $140 a barrel. The U.S. had this huge trade deficit in energy. High demand, not enough domestic supply, China's demand growing. It was a big problem.
Right.
But then the economic crisis of 2008 to 2009 kind of reset the whole supply and demand equation. Things started changing unexpectedly.
And the change was dramatic, according to the letter. New U.S. oil reserves developed significantly. Between 2007 and 2009, for every barrel produced, 1.6 barrels of new reserves were added.
Yeah, finding more than they were using.
And in 2012, U.S. crude oil production jumped 14% from the year before. Estimates predicted another 25% increase within just 2 years. And natural gas, they said the amount of new reserves was just astronomical.
Astronomical, yeah. The International Energy Agency, in a November 2012 report, even predicted the U.S. would be energy independent by 2035.
Wow.
Giverny believed the most important consequence would be a decrease in the U.S. trade deficit. That should help the U.S. dollar foster growth in places like Wyoming, North Dakota, Montana.
Okay, sounds like a massive positive trend.
Huge. But despite this optimism, Giverny remained cautious. They stated the energy industry is difficult to predict, and it had changed so much since 2007 that it actually fell outside their circle of competence for direct evaluation.
Okay, so even with this huge positive trend, they stuck to what they knew best.
Exactly. That's a crucial lesson. Know your limits, know what you don't know, even when something big is happening. Stick to your expertise.
So how did they benefit from this energy boom then, if it was outside their direct circle of competence?
Great question. They found a way to benefit indirectly. They invested in companies like Union Pacific and Burlington Northern Santa Fe, which interestingly became part of Berkshire Hathaway.
Oh, the railroads.
Right. These companies profit from the increased rail cargo generated by this energy boom, transporting the oil, the equipment, everything.
Clever. So they captured the upside without having to become experts in the volatile energy sector itself.
Precisely. A perfect example of finding an indirect play on a major theme.
This deep dive really reveals something fundamental about Giverny's approach, doesn't it? They don't evaluate investments by short-term stock price swings. Their wiring, as they put it, is such that we consider ourselves owners of the companies in which we invest. Why is that owner mindset so critical for them?
It's absolutely critical because it shifts their entire focus away from market noise towards fundamental business value. And to assess this, they use a measurement developed by Warren Buffett. Owner's earnings.
Okay, owner's earnings. What's that, roughly?
Roughly, it estimates the increase in the company's intrinsic value. You add the growth in earnings per share, the EPS growth, and the average dividend yield of the portfolio. It's trying to measure the real cash the business generates for its owners.
Right, not just the stock price on a given day.
Exactly. They quote Keynes. It is better to be roughly right than precisely wrong. It's about the underlying reality.
So for 2012, the intrinsic value of their companies as a whole went up 19%. That was 18% from earnings growth and 1% from dividends. Meanwhile, their stocks rose about 23%, excluding currency effects. How did that compare to the broader market, the S&P 500?
Well, for the S&P 500, the underlying earnings growth was only 5%. You add dividends, maybe 8% total intrinsic value growth. But the S&P 500's total return that year was 16%. So the market return was much higher than the underlying business improvement.
Interesting disconnect there.
Yeah, and this is where their long-term view really comes into play. Since 1996, Giverny's companies increased their intrinsic value by 726%. That's about an 8-fold increase.
Wow, 8 times.
While their actual stock value only rose 606%. Close, but lagging the business growth. Now look at the S&P 500 over that same period. Aggregated intrinsic value increased 229%, and stock prices rose 216%. Much closer alignment, but much lower growth overall.
Okay, so what's the takeaway from that comparison?
It perfectly illustrates their point. Market performance and corporate performance are rarely synchronized over just one year. But, as they say, as more time passes, the synchronization between the two inevitably begins to reveal itself. Patience pays off.
So over 17 years, their portfolio's return beat the S&P 500 by 5% per year, simply because their underlying companies grew their intrinsic value 5% faster per year.
That's exactly it. That's how they plan to meet their future performance goals. Not by trying to time the market or guess economic trends, but by picking companies that can consistently grow their intrinsic value faster than the average.
It's a testament to their whole investment philosophy, isn't it, which they lay out for new partners.
Yeah, the key tenets are pretty clear. They believe stocks are the best long-run investments. They believe trying to predict market timing is futile. And crucially, that a stock's return will eventually reflect the increase in the underlying company's intrinsic value.
And they focus on companies with sustainable margins, high returns on equity, good long-term prospects. Yeah.
And management, that is, and I love this description, brilliant, honest, dedicated, and altruistic, high bar.
Definitely.
And here's a critical insight they share. The market often treats stocks like casino chips. This irrationality sometimes lets them buy great businesses well below their intrinsic values. That's the extraordinary advantage to the intelligent investor. Market fluctuations become opportunities.
Okay, this next part is fascinating. Let's unpack this. It's not every day you see a fund manager proudly share their mistakes. Giverny Capital systematically has a 5-year post-mortem analysis. They learn from achievements and errors, and they highlight that errors from omission, non-purchases, are often more costly than errors from commission purchases. Why is this section so important for us as learners?
Oh, it's incredibly valuable for you, the listener, because it gives real-world examples of how even seasoned, successful investors mess up. And maybe more importantly, how they analyze those mistakes. It teaches humility, continuous learning, things crucial to investing.
Absolutely. So, starting with their bronze medal, JP Morgan. In the summer of 2012, the bank announced an unexpected loss. This led to what Giverny called an exaggerated media frenzy. The stock tumbled from $44 down to $32. That was a $40 billion drop in market value, which seemed, quote, out of line with what looked like a realistic $4 or $5 billion actual loss. So they saw an opportunity, right?
They absolutely did. They actually thought the stock was undervalued even before the drop. So at $32 with a PE ratio that's priced to earnings of just 7, it looked like a rare opportunity. Really cheap relative to its profits.
So did they buy?
No. Despite publicly recommending it, Giverny stayed on the sidelines. They cited difficulty choosing what to sell to free up cash and already having large financial exposure. They later admitted these excuses are regrettable because the stock quickly rebounded 50% to $48.
Ouch.
Yeah. The lesson there is that even when you see clear value, inaction getting stuck can be really costly. Analysis paralysis, maybe.
Okay, next up, the silver medal, Lumber Liquidators, LL. Giverny bought shares back in 2010. They visited the company, were impressed by its low-cost structure, sounded good, but then in 2011, the company hit some problems. A new IT system causing issues, falling same-store sales, flat earnings per share. The CEO left.
Yeah, rough patch.
So Giverny sold around $17. They figured the investment thesis was broken. What did they learn from this one?
Patience. They learned about the cost of impatience, opposite to their errant prognosticating, as they put it. The company totally turned itself around. Sales jumped 17% in 2012, earnings surged, operating margins improved.
And the stock?
The stock more than tripled. It hit $60 by February 2013.
Wow, from $17 to $60.
Yeah. They acknowledged a flagrant lack of patience. It's a common trap, right? Selling too soon when a good company hits a temporary rough patch.
Definitely a tough lesson. Okay, and finally, the gold medal mistake. Stericycle. This was an error of omission, not buying. About a decade earlier, they learned about Stericycle, leader in medical waste collection. Exactly their kind of unexciting business.
Right, the kind that doesn't attract tons of competition or get disrupted by tech easily. Steady Eddie.
But its financial results were anything but unexciting. Annual revenues grew from $400 million to nearly $2 billion. Earnings per share went from $0.55 to $3.30. That's a 20% annualized growth rate.
Incredible growth. So why was it a mistake? Why did they miss out for so long?
That's the painful part. They avoided it for a decade because its PE ratio always traded at lofty levels. It looked expensive.
Okay.
It was 29 times earnings in 2002, still 28 times earnings in 2012. So they waited in vain for a better price.
And the
The
stock?
stock went from $16 to $92 over that period.
16 to 92.
Oof. Yeah, an error of almost 500%. Their big lesson.
Their lesson was crucial. When you find a truly high-quality enterprise with a promising future, refusing to pay a slight premium relative to average companies often becomes a very costly mistake.
So the real cost wasn't maybe overpaying slightly, it was not paying at all for that exceptional quality and growth.
Exactly. Sometimes quality is worth paying up for. A very powerful lesson from their biggest admitted error.
Okay, bringing it all together then. At the end of the letter, Giverny expresses unwavering optimism for the stock market and their businesses. They state that the potential for stock appreciation is inversely proportional to the market's valuation. So why were they so optimistic at the end of 2012?
Well, from that valuation perspective, the news looked good to them. The S&P 500 was trading at only 14 times estimated earnings for 2013. That seemed very reasonable. And critically, they saw widespread pessimism of the financial community. For a contrarian value investor like Giverny, that pessimism is an ideal ingredient for future appreciation. Widespread fear equals future opportunity.
And that pessimism was pretty evident, right? Investors had been fleeing stocks since the 2008 crisis, selling $500 billion worth of equities, pouring $1 trillion into bond funds instead.
Huge shift away from stocks.
And the U.S. Consumer Confidence Index, which they call their favorite contrarian indicator, ended 2012 at 67. Normal is 100. It even dropped to 59 in January 2013. That's usually a level you see during a recession. What does that kind of sentiment tell you?
It tells you that very few people wanted anything to do with stocks.
Yeah.
Fear was dominant. And this wasn't just individual investors. It extended to institutional investors, too. Top American university endowment funds, for example, had slashed their equity exposure from 45% 10 years prior down to just 27%.
Wow, only 27% in stocks.
Yeah, while increasing alternative investments like hedge funds and private equity to 61%. This kind of herd behavior away from equities just reinforced Giverny's contrarian view that stocks were likely undervalued.
So Giverny concludes that equities will be the best asset class in the coming years simply because they seem to be the most unloved and undervalued.
That's their core message looking forward from 2012. Long-term value investing, especially in quality companies. Companies with solid balance sheets, dominant business models, reasonable valuations. That approach is poised for strong performance when general sentiment is that low. It's really a powerful testament to their disciplined approach, their risk management, and their fundamental belief in the long-term power of owning great businesses.
What an incredible deep dive into Giverny Capital's 2012 letter. It feels like we've covered so much ground, from their impressive performance numbers to their strategic market observations, that unique owner's earnings philosophy, and maybe most instructively, learning alongside them from their podium of errors.
Absolutely. This deep dive really underscores that intelligent investing isn't just about the numbers, is it? It's about cultivating a disciplined mindset, sticking to a long-term view, and crucially, having the humility to constantly learn from your wins and your mistakes. The way they candidly shared their errors offers such valuable insights into the human side of investing.
So, thinking about our listeners, what does this all mean for you as you think about how to gain knowledge quickly and thoroughly?
Well, considering Giverny's podium of errors, especially that gold medal mistake with Stericycle, it does raise an important question for your own learning journey, doesn't it? In your pursuit of knowledge, whatever field it's in, where might you be missing out on really valuable quality enterprises, quality ideas, quality opportunities, maybe by waiting in vain for a better price or by being overly cautious about paying a slight premium when the underlying value and the future outlook are truly exceptional. Something to mull over until our next deep dive.